Hey guys, Chris from Appropriation here, and in this video I'm going to show you how to prepare the appropriation account for a partnership. So the first question you should be asking yourself is, well, what is an appropriation account and why do we need it? Put simply, an appropriation account shows the distribution of the profits to the partners. Right? Now, why do we need it? So just to think about it, why do people start a business? To make a profit. To whom does the profit go? To the owners. Now, most of the questions you guys may have done up to this point may involve sole traders. Businesses where you have one owner. And guess what? If you have one owner, that person is going to get all of the profit at the end of the period. So when you do your income statement, that net income or net profit, whatever you call it, is going to go to the owner's capital account. But if you have multiple owners, we need to have a way to show the sharing of the profit between or among these people. Now, a partnership can be between 2 and 20 people. As a matter of fact, if you do a Google search, you will see that that maximum number could vary according to what country you're in. So it doesn't have to always be 20, but for the purpose of CSEC, we're going to say 20. Now, something else real quick. I'm not going to be getting into the whole theory behind partnerships, advantages, disadvantages, because I want to get straight to the appropriation account. But I want to, of course, set some context. We need to know why we are doing what we're doing, right? Because it helps us understand how to do things a bit better. Well, it works for me that way, right? And okay, so that's what an appropriation account is. Now, what goes in it? So like we said, a share of profit. Now, how do we know how to share the profit? Well, the partners are supposed to draw up something called a partnership agreement, or you might know it as a partnership contract, a deed of partnership, a partnership covenant, whatever you call it, it all means the same thing. It's a document that shows all of the things on which the partners agree in terms of how they're going to run the partnership, who gets what, that kind of stuff. Now, inside there, they're going to have something called a profit sharing ratio, which is how they're going to break up the profit among them. You might also have information on partner salaries, interest on their capital. They may have to pay interest on drawings. So all of these things can appear in the appropriation account, and I will explain them each one in more detail when I get to that example. So by the way, just so you know, I have 13 examples, right? The reason I have so many is because I don't believe in giving the finished product with every single item at once. I like to build things sequentially and take things one thing at a time. I don't like to give, like I said, the whole format all at once, because I think it affects a lot of people negatively. For example, when you guys may have been in a trading account, you may have just received this whole format and you had to memorize it, and that is just how things are done. That's not how I teach it, and I think you guys would have seen my video on it. If not, I will put a link up in a card up there and a link in the description below, so you can take a look at how a trading account is built, right? So same thing here. I'm going to do the pieces of the appropriation account sequentially and keep adding one thing after another until you have a very comprehensive example at the end of this video. Anyhow, so without further ado, let's get into some examples. But before I get there, if you guys have any questions about anything at all in this video, please put it in the comments below. And I'm doing something a bit different in this video in terms of how I show the question and the answer, because somebody actually sent a message to one of my students saying that in the videos they watch it on their phone and sometimes the words appear a bit too small even though I zoom in. So I'm trying to not do question on one side, answer next side. I have the question on top and the answer below, and it'll kind of scroll as we go. So I'd like some feedback about that from you guys. So please feel to send it in the comments below. And yeah, so let's get to the questions. All right, guys. So let's take a read of the first example. So we start off here with Trip and Fall. Start a partnership on January 1st, 2018, but neglected to draw up a partnership agreement. Ooh, that's not a good idea. At the end of the first year of trading, their net income was $36,000. Prepare an appropriation account for the year ended 31st December 2018. So the only thing we have to do here is share the profit of $36,000 between these two partners. Now, how do we know how to share it? There's no agreement. Well, in the absence of that, what do you think is the fairest thing to do in terms of sharing profits between two people? Share them equally. So that's all we're going to do here. So let's see how to head up an appropriation account. So we put the name of the partners, Trip and Fall. The name of the statement is the appropriation account, and we put the period to which it applies. For the year ended 31st December 2018. Let's get some dollar signs going, and we're going to start with the net profit before appropriation of $36,000. Or net income, whatever you choose to call it, that's fine by me. Now we're going to share the profit. Share of profit, share the profit, profit share, whatever you call it. Because I'm saying that because I know different teachers call it different things. So I'm not trying to confuse you. I'm just trying to cater for those who may know these things by a different name. So I do apologize if I'm confusing anybody. I'm sorry. All right. Now, how do we share it? So we share it equally, because anytime the partnership agreement doesn't say how to share profit, you automatically default to sharing it equally. So for Trip, he's going to get 36,000 divided by 2, which is 18,000. And guess what Fall is going to get? The same 36,000 divided by 2, which is 18,000. If we add up those two shares, we get back 36,000. And when subtracted from the profit, we are left with 0. Now, once again, there's a different way that I've seen some people's teachers show them, which is where this item here, this net income, is in like a double line thing, like when you finish a T account and you have the total, or when you finish the income statement and you have that net income there in double lines. And what they do is they just make sure the total here matches that total. So that's another way you could do it, because as far as I know, there's no one right way to do this thing. There are different ways it could be presented, but there's a minimum amount of information that should be shown. Certain things have to be shown, right? The income before appropriation and the appropriations. All right, so that's it for the first example. So let's hit the second example. Actually, you know what? Let's check it out one time. So Jump and Wave started business on January 1st, 2018 and agreed to share profits in the ratio 60% to 40%. So we're given a ratio this time. At the end of the first year of trading, their net income is $36,000. Prepare an appropriation account for the year ended 31st December 2018. Okay, so now we're given a ratio and we're given it in percentage terms. So let's head up, Jump and Wave, appropriation account for the year ended 31st December 2018, $, net income before appropriation is 36,000. You're going to see that figure repeat quite a bit because it's a very easy figure to share up. And right, so share of profit. So Jump gets 60%. 60% of that is 21,006, and Wave gets 40%, which I think is 14,004. And you add those two things together, you get back 36,000, which matches the profit before appropriation, and everything is shared between the partners. Okay, let's take a look at another example. Here we have short and sweet, which are like most of these initial examples. It's short and sweet. They started a partnership January 1st, 2018, agreed to share profits in a ratio 2 to 1. So now it's not a percentage, now it's an actual ratio like in maths, right? At the end of the first year of trading, their net profit was 36,000. Prepare an appropriation account. Okay, so let's head up. Short and sweet. Appropriation account. Year ended 31st December 2018. $, net profit before appropriation 36,000. Share of profit. Okay, so I know some of you guys aren't big fans of maths and ratios could be a bit daunting. It's a very simple thing to do. All you have to do is add the numbers in the ratio together. 2 and 1 will give us 3. And all we're going to do is we're going to take each of those individual numbers, the 2 and the 1, and put them each over that total, 3. So it's going to be 2/3 and 1/3. So short gets the 2/3 share and sweet gets the 1/3 share. So short will be 2/3 of 36,000, which is 24,000, or 36, I say 34, whatever. And sweet gets 1/3 of 36,000, which is 12,000. 24 and 12 will give us back 36. And that ties back to the net profit before appropriation. So once again, all you have to do when given a ratio is add the individual numbers in the ratio together to get a common denominator, and then put each number from the ratio over that common denominator. Let's go again. Right, so Get in the Car and Drive formed a partnership on January 1st, 2018 and agreed to share profits in the ratio 3 to 2 to 1. At the end of the year, their net profit is $36,000. So we have a partnership appropriation account to prepare to show the share of profit among the partners for the year ended 31st December 2018. So here you're seeing it called not just an appropriation account, but a partnership appropriation account, which is fine. So Get in the Car and Drive, partnership appropriation account for the year ended 31st December 2018. Just by the way, you're going to see different names other than appropriation account and partnership appropriation account appear further down. $, so net profit before appropriation is 36,000, and we're going to share that profit. So the ratio now is 3 to 2 to 1. So what did we do just now in the previous question? We added the individual numbers in the ratio, got a total, and put each number over that total. So 3 plus 2 plus 1 is 6. So it's going to be a 3/6 share to Get in, 2/6 to the car, and 1/6 to Drive. Let's take a look. So Get in got 3/6 of 36,000, which is essentially a half of 36,000 is 18,000. The car got 2/6, which is essentially 1/3, which is 12,000, and 1/6 is 6,000. Adding 18 and 12 is 30, 30 and 6 is 36, and that matches with the profit above, profit before appropriation. So it all ties back once again. Okay, now let's take a look at another example. So let's see, I wonder if anybody can recognize these names. Well, Steve, Tony, and Bruce started a partnership on April 11th, 2011. If anybody knows those, recognizes those three names in context with that date, hit me in the comments below. All right, so they contributed capital 40,000, 30,000, 20,000 respectively, which means Steve gave 40, Tony gave 30, Bruce gave 20. Although Tony is supposed to be the richest of all three of them, but we'll come back to that. All right, they agreed to share any profits or losses in the ratios of their capital balances. Ooh, this is an interesting one. At the end of the first year of operation, the net income was 36,000. Prepare a profit and loss appropriation account for the year ended 10th of April 2011, showing the share of profit. All right, so just, pardon me with the 10th of April and 11th of April. Those are specific dates just for this, just to see if anybody guesses where these people are from. All right, anyhow, so Steve, Tony, and Bruce, profit and loss appropriation account, so you see there's a different name for it now. For the year ended 11th of April 2011, 10th of April, right, dollar signs. We now also have the profit before appropriation, 36,000, share of profit. Now it says to share profits and losses in the ratios of their capital balances, which are what? 40,000, 30,000, and 20,000. So we treat it just like a regular ratio. We add them together, 40, 30, and 20 is 90, and we put each of those values over the 90. And guess what we could do with all those zeros? Cancel them. So all we're going to have is it's like a 4 to 3 to 2 ratio. 4 and 3 and 2 is 9, so it's a 4 ninths, 3 ninths, and 2 ninths split. Let's take a look. So Steve gets 4 ninths. Which is 16,000 here. Tony gets 3 ninths, which is a third, and Bruce gets 2 ninths. And what's going to happen? We're going to add up 16 and 12 is 28, 28 and 8 is 36, and that ties back with the profit before appropriation. So what we've seen in this question is that they didn't give us a ratio. They told us that the profits and losses had to be shared in the ratio of the partners' capital balances. So you add up all the capital balances, and of course, if there are extra zeros, you can cancel off the zeros. Although just be careful how you do that, because some people are not sure how to do it. If you're not sure how to do it, comment below, let me know, I'll show you. But yeah, 40,000, 30,000, and 20,000 is 90,000. You put each of those over the 90,000, you could cancel the extra zeros. You get 4 ninths, 3 ninths, and 2 ninths. Okay guys, so in this example, we're going to have our first look at where partners earn salaries. Now, partners' salaries are not expenses because we are accustomed seeing salaries and wages up in the expenses section in the income statement. But partners are not employees of the business. They own the business. And any distributions to partners are appropriations of profit, not expenses. And hence will go in the appropriation section. Partners may choose to take salaries in addition to their interest, in addition to their share of profit, because they may take an active part in the running of the business and feel that they need to be compensated for that. Okay, so let's take a look at the question. So it says, Shut Up and Work started a partnership on Jan 1st, 2018 and agreed to share the profits in the ratio 5 to 4. They also agreed to receive salaries of 20,000 and 30,000 per annum, respectively. Per annum means per year. That's a very important thing. It'll come back into play later on. At the end of the year, the profit before appropriation was $86,000. Prepare an appropriation of profits account for the year ended 31st December 2018. So here we see another name, appropriation of profits account. So let's head it up. So we have Shut Up and Work, appropriation of profits account for the year ended 31st December 2018. Okay, dollar signs. Net profit before appropriation is 86,000. We're going to less appropriation. So here now we're seeing a heading that says less appropriation. So it kind of sets the stage for, hey, look, this is how we're going to share up the profits or the earnings to the partners. So we have salaries. Shut Up gets 20,000. Work gets 30,000, which means there's a total appropriation so far 50,000, which leaves 36,000 to be shared between them in the ratio 5 to 4. Now, what do we do with this ratio 5 to 4? We add the two numbers together. 5 and 4 will give us 9. So we have a 5 ninths and 4 ninths split. Shut Up gets 5 ninths. Oh, sorry, yeah, so share profit after appropriation. Sorry, I forgot about our little subheading. Right, so Shut Up gets 5 ninths of 36,000, and Work gets 4 ninths of 36,000, which of course will add back to 36,000. Now, just so you know, sometimes people call this item the share of profit after appropriation different things. I was taught that it was called share of residual profit, Sometimes it's simply called share of profit, share of remaining profit, whatever it's called, we do the same thing with it. We share it between or among the partners. Okay, let's take a look at a follow-up example now. So, Salmon On Grass formed a partnership on Jan 1st, 2018. They agreed to share profits in the ratio of 50% to 40% to 10%. So now we have percentages. They also agreed that Sav and Anna will get salaries of $20,000 and $30,000 respectively per annum. So what about Grass? Now sometimes there's a partner can be what you call a sleeping or a silent partner, where he or she takes no part in the active running of the business, but they simply want to get profit. So it may very well be that Grass is a sleeping partner. At the end of the first year, their profit before appropriation amounted to $86,000. Prepare an appropriation account. Okay, so Salmon On Grass appropriation account for the year ended 31st December 2018, $. Profit before appropriation is $86,000 less appropriation. Salaries, so we have Sav who gets $20,000, Anna who gets $30,000, total salaries $50,000. From 86 gives us 36 after share, right? Share of residual profit or share of profit after appropriation. And we have Sav, now 50%, 40%, 10%. So you're just going to multiply that percent by that 36,000. 50% of 36,000 is a half of 36,000, which is 18,000. Sav is 40%, which is 14,400 in this case, and Anna is 10%, which is, sorry, Sav, Anna, and Grass, right, which gets 10%. Who gets 10%, sorry. Add it all up, you get 36,000, and of course, take it away, you get back to zero. So you shared up everything among the partners. Let's take a look at another example. Okay, Dr. Manhattan, anybody watching Watchmen on HBO? Right, Dr. Manhattan are in partnership, sharing profits in the ratio of 3 to 4, and earning monthly salaries of $3,000 and $4,000 respectively. For the year ended 31st December 2018, the partners earned a net profit before appropriation of $168,000. Prepare the partnership appropriation account for the current year. Okay, so Dr. Manhattan, sorry, my bad. Appropriation account or partnership appropriation account in this case for the year ended 31st December 2018, $. Profit before appropriation is $168,000 less appropriation. So salary, so it's a monthly salary, and we are doing an appropriation account for a year. How many months are there in a year? 12. So for Dr. his or her salary will be 12 by 3,000, which will be 36,000. For Hatton, his own will be 4,000 by 12, which will be 48,000, giving us 84,000 of total appropriation, total salaries to be given to the partners, leaving us with 84,000 to share between them. The ratio is a 3 to 4 ratio, so we have share remaining profits. So Dr. gets 3/7, which is 36, I believe, and Hatton gets 4/7 of 84, which would be 48. Yeah, all right. Adding 36 and 48 will give us 84. That'll give us back, well, 0 when you net it off. All right, so we see here monthly salaries can be a thing. Okay, so let's take a look at this example now, which introduces interest on capital. Now, let me just explain interest on capital very briefly. So, people start a business to make a profit, and they do so by investing their own money, which is called capital, into the business. Now, it's an investment, and people expect to be rewarded for their investment. Now you might be saying, well, okay, well look, they're getting a share of profit, so that's fine. That's all well and good. But suppose the business makes a loss, or the business, for some reason, they don't get a share of profit. So what the partners might want to do is they might want to kind of guarantee themselves a minimum return on their investment, or a minimum reward on their investment. And that's where the interest on capital comes in. You can also look at it as trying to compensate with the opportunity cost of investing elsewhere. Those of you doing principles of business and economics, you all would have met that term, opportunity cost, right? And all the times people just rattle off, the next best alternative foregone. I want to ask them, what does that mean? The next best alternative foregone. That's what it means. No, look, it's all nice and well and good to learn fancy definitions and big words. I'm not saying don't improve your vocabulary and learn to use these nice fancy words, but you need to understand what it means. It simply means opportunity cost. When you buy something, there's a financial cost, the cost of money, but you also forego what else that money could have bought you. For example, if you were hungry and thirsty, but you only had enough money to buy either something to eat or something to drink, let's say you opted for something to drink, then you're not only sacrificing or paying with your money, you're also sacrificing the food you could have eaten. So now you might not be thirsty anymore, but your belly's still hurting because you're still hungry, right? So it's one pain or the other. Anyhow, sorry, I don't mean to rant too long. Anyhow, so the interest on capital is an appropriation of profit, and it is paid to partners out of net income after all expenses have been covered, and it's part of appropriation. So let's take a look. Let's take a read. So Bad and Bougie are in partnership, sharing profits in the ratio 2:3. They have contributed capital in the amount of 100,000 and 150,000 respectively, and have agreed to receive 10% interest on their capital balances. All right. They have also agreed to receive salaries of 30,000 and 25,000 per annum, respectively. Prepare a partnership appropriation account for the year ended December 31st, 2018, if their profit before appropriation for the year is 120,000. All right. So we know what's going to happen here. Name, Bad and Bougie. Okay, no, I'm sorry. I don't even know the song. I just know it's a thing. All right. Appropriation account, partnership appropriation account for the year ended 31st December 2018. $. Net profit before appropriation, $120,000. Less appropriation, I'm going to start with the interest on capital. Now, just by the way, like I mentioned before, there's no one right way to do this. You can put the salaries first. You can put the interest on capitals first. To me, it doesn't matter. Arithmetically, it's going to end up the same thing anyway you take it. And once all the details are there, it's fine. So, let's do Bad. So Bad has 100,000 of capital inside and is receiving 10% interest on said capital. 10% of 100,000 is 10,000. Bougie, 10% of 150,000 is 15,000. Total interest on capital is therefore 25,000. Salaries. Each agreed to receive a salary of 30 and 25 respectively. So Bad gets 30, Bougie gets 25, total of 55. Adding those two together gives us 80. Now we're going to subtract that from our net profit before appropriation, the 120, and that's going to give us 40,000. That's the profit to be shared. So we have to share the profit after appropriation. Bad and Bougie are going to share in ratio 2:3. What do we do with that? We add 2 and 3 together to get 5. Bad gets a 2/5 share. Bougie gets a 3/5 share. That's 16,000 and 24,000 respectively. Adding those two shares gives us back 40. And therefore we have our profit being shared between the partners completely. Let's take a look at the next example. So Harry and Ron, well, I'm pretty sure you can guess who. If you can't guess who these are, then I'm real old. All right. Harry and Ron are in partnership, sharing profits in the ratio 1:2. So I managed to drop a nice little format here. So Harry and Ron have capital, interest on capital is 10%. Salary per year, right? Drawings. Oh, interest on drawings. So I went straight to interest on drawings. I didn't bother to do multiple interest on capital examples. Now, what are drawings? Drawings is when the owner or owners remove resources from the business for their personal use. They may take out cash because they want to buy something. They may take out stock because they like the stock that they have, whatever the case is. They may have, maybe there's a vehicle or a car that the business has that they want. So, hey, I taking that, I go with that. You know? So drawings remove resources from the business, and hence if you take resources from a business, they have less resources now than they had before, which means that they can no longer, or they may be at an impaired capacity to take advantage of opportunities or to operate. So you don't really want your owners taking resources within the business. If they have to, if they're entitled to a certain limit, fine, and that's something that should go in the partnership agreement. Are partners first of all allowed to take drawings? Maybe in the first year to 2 to 5 years, partners should take no drawings, because in the first few years of a business life, you are working very hard and income is not as large as you think it might be. When you are allowed to, are there limits? And then on top of that, will we charge the partners interest on the drawings? Now, why would you charge partners interest on drawings? So just like if you go to a bank and you borrow money, you pay interest on that money. You pay the bank back more than you borrowed because you are compensating the bank for the opportunity cost of the money, inflation cover, and the risk you don't pay back. There's a lot of things. Now, same thing for the partnership. They might say, look, we don't really want our owners or partners taking out resources and leaving us with little to no resources, or not enough to take advantage of opportunities or to operate, generally speaking. So what we're going to do, we're going to charge them interest. So you want to borrow money, fine, but it's like a loan, so you have to pay us back plus interest. Now, the interest on drawings is not an appropriation, nor is it an expense, nor is it a revenue. So so first of all, we added to net profit before appropriation Yeah, that's what we do. We added to net profit before appropriation. So we have Harry and Ron appropriation account for the year ended 31st December 2018, dollar signs. Net profit, 118,000. Add interest on drawings. Ooh, all right, let's take a look. So Harry had 24,000 worth of drawings at 5%. So 5%, 24,000 will give us 1,200. Ron at 16,000 at 5%, then that's 800, right? 12 and 8 is 2,000, which means when you add that to your net profit, you're going to get 120. And that is now what you're going to be using to appropriate. Right, so let's appropriation. So interest on capital. Let's go. Harry had 100,000, 10%, so that's 10,000. Ron had 150,000, 10%, that's 15,000. Total is 25,000. Salaries. So Harry had 30, Ron had 25, total is 55. 55 and 25 is 80, and we're going to subtract that from the 120,000 up there, which will give us 40,000, which is the profit to share to the partners. Ratio is 1 to 2. Now that's interesting because 1 and 2 is 3, so you're going to have a 1/3, 2/3 split. But 40,000 is not a multiple of 3. We're going to get decimal places. So what do? Well, in this case, I round off to the nearest whole number, which in this case for Ron, Harry would be 13,333. Ron will get 26,667. Now, if you don't run off properly, you might end up with 26,666. And when you add those two shares together, you're going to get 39,999, which means you're going to have $1 left over somewhere. Now, when you're rounding off, yes, sometimes a partner may look like he or she might get slightly more than they're supposed to get. If it's a few cents or a couple of dollars, it's really not a big deal. So don't bite up yourself on it, right? If, however, your teacher says, you must put the dollars on cents, fine. Give your teacher what he or she wants. Don't fight it down, all right? Okay, we add up 13,333 and 2667, we get 40,000, which is the exact share of the profit, and things are looking pretty good. All right, let's take a look at another example. Rory and Amy, right? So anybody could guess where that from? Any Doctor Who fans out there? No? 11 was anybody's favorite? Okay, don't worry, sorry. 11 was also from Stranger Things, so if you like Stranger Things, pretty cool. All right, Rory and Amy are in partnership, sharing profits and losses 4 to 5. 100, 150, 10% on their investments. Salaries, 80, 120. 6% interest per annum on drawings. Interest is per annum, which means per year. During the year, Rory had 12,000 of drawings outstanding for 6 months. And Amy had 10,000 of drawings outstanding for 3 months. Why are the months important? That's because interest is paid per annum, which is per year. So if you took a loan and they charge you 10% per year, but you only had the loan for 6 months, you will not be required to pay the full 10% for the full year. They're going to scale it down by a half. If you took out the loan for 3 months, you're only going to pay 3 months worth of interest. So that's the complication here. Let's take a look. So Rory and Amy, appropriation account for the end of 31st December 2018. Dollar signs. So net profit before appropriation is 332,490. Add interest on drawings. Let's take a look. So Rory had 12,000 of drawings outstanding for 6 months, and it's 6% interest. So you're going to find 6% of 12,000, and then you have to multiply that by 6 out of 12. 6 over 12. Why 6 over 12? Well, his drawings was outstanding for 6 months. And how many months are there in a year? 12. So it's going to look like this. 12,000 by 6%, which is the interest for a whole year, but multiplied by 6 over 12. Once again, why 6 over 12? Because his drawings was only outstanding for 6 months out of 12. Similarly for Amy, she had 10,000 worth of drawings outstanding for 3 months. So her one will be 10,000 by 6% and then further multiplied by 3 over 12. 3 months out of the full 12 in a year. And that's going to give us a total of 510. Right? So once again, this is one of the complications that could arise. You can have drawings outstanding for part of a year. Let's take a look and see how this progresses. So if we add that to our net profit before appropriation, we get 333,000. That's appropriation. Okay, interest on capital. 10% of 100, 10% of 150, giving us 25 in total. Salaries, 80,000, 120,000. That's a lot. That's 200,000. Wow, okay, and salaries a lot. All right. So 225, and we have to subtract that from 333. So 333 minus 225, I think is 108. And we have to share that profit in the ratio 4 to 5, which is 4 nines and 5 nines. which is going to give us these two values here, 48,000, 60,000, adding back up to 108,000, and there we go. Okay guys, so last two examples. So we have punch me in the face, are in partnership, sharing profits in ratio 2:4. So we have information for capital, drawings and salaries. We have salaries per month, net profits, prepare an appropriation account for the 6-month period to June 30th, 2018. So here now we have a little complication. We are doing an appropriation account, but it's for a 6-month period, a period that is not a year. So the implication therefore is that anything that has to do with a percentage or anything that accrues monthly, you're going to have to pay attention to the figure that goes in the appropriation account for those items. Let's take a look. So the first thing we're going to do is head up. So let's go. So you have punch me in the face, appropriation account for the 6 months ended June 30th or 30th June 2018, $. Net profit before appropriation, 166,920. Add interest on drawings. Okay, so drawings, punch me had 8,000 of drawings at 12%. So we saw just now, if you have drawings outstanding for part of a year, you have to multiply. So here it'll be 8,000 by 12% or 12% of 8,000 multiplied now by 6 months out of 12. Let's take a look. Right, so 12% of 8,000 by 6 out of 12. Same thing for, who is it? The face, right, drawings, 10,000 by 12%. And same 6 months. So we're going to get 1080, and that's going to give us 168, I believe. Okay. Right. So once again, anything that accrues per month or anything that has a percentage, which is per annum, you're going to have to adjust for the portion of the year for which it was outstanding or for which we are doing the appropriation account. Sorry. Right. Let's appropriation. Interest on capital is the first thing. So we have 10% of the 200 multiplied by 6 out of 12, right, and then 10% of the 400 by the same 6 out of 12. That's going to give us a total of 30. Salaries, so we see we have salaries accruing per month. So punch me is 5,000 per month, 5,000 by 6 is 30. The face is 4,000, 4,000 by 6 is 24, total of 54,000, which gives us 84,000 worth of appropriations to pay out to partners. That's going to be subtracted from the 168, which is going to give us 84 to share between them in the ratio 3:4. So that's 3 sevens, 4 sevens. So I think that's 36 and 48. Right? Punch me gets 3 sevens. The face gets 4 sevens, totaling back to 84,000 and cancelling out all of the profit left. Okay, one more example to go. Let's take a look and see what this example is about. Hot and sweaty boy are in partnership sharing profits in the ratio of their capital balances. Okay, so we have another example that came back. Hot and sweaty, capital, drawings. So we see next to drawings we have 9 months and 4 months. So we know we're going to have to adjust those. Net profit before appropriation was that, but the interest expense on a $50,000 was not deducted. Okay, in this particular example, there's an adjustment to be made to net profit before you even get to interest on drawings. This, I've seen this come in, well, relative to today, which is December 2019, in a couple of recent CSEC papers, that item came, not specifically maybe interest, but an adjustment that had to be made to net profit. They forgot some expense or something, so you're gonna have to now go and subtract that before you even start anything with appropriations. Let's take a look and see what's gonna happen. So hot and sweaty, a partnership appropriation account for the year ended 31st December 2018, $. So net profit, just net profit by itself, before interest as a matter of fact, right? So 567,780. The interest is 10% of 50,000, which is going to give us 5,000. So less interest, 10% of 50 is 5. That's going to give us 562,780. Now we can go to interest on drawings. Let's go. So hot had 10,000 at 12% outstanding for 9 months. So that's 10,000 by 12% by 9 over 12. Or 12% by 10,000 by 9 over 12. Same difference, right? Multiplication is commutative. The order in which it happens doesn't matter. Similarly, for sweaty, we're going to have 12% of 8,000 by 4 over 12. That's going to give us 320. Add it together, you get 1220. We're going to have 564. Interest on capital. Let's see. So interest on capital, 10% of 25 for hot, and then 10% sorry, 10% of 250 for hot, and then 10% of 350 for sweaty. 60 in total. Salaries, 10,000 a month. So it's a whole year, right? Okay. So 10,000 by 12 for hot, 12,000 by 12 for sweaty, totaling 264, giving us 324. And we're going to have to subtract that from 564. Okay. That's going to give us 240. And we have to share that in the ratio of their capital balances. So once again, we're going to add the capitals, 250 and 350, we're going to get 600. So that's 250 over 600, 350 over 600. Or if you want to cancel it down, I think that's going to give us a 5 12ths and 7 12ths if we divide by 5. Let's take a look. So hot gets, well, I left it as 25 over 60, right? But that's a 5 12 split. And he or she gets 100, and sweaty gets the 35 over 6 or 7 12 split, giving us 240,000. Adding back up to 0. Okay guys, so I know I said at the start of the video I had 13 examples to do, and if you keep in track, 13 have passed already. But I was teaching my class this, actually the day I was recording this video, and I did a question with them that I realized had something I wanted to show you guys. So we're going to take a look at this question now, and it is the last question, I promise. All right, and thanks for staying with me so far. Okay, so shut up and dance are in partnership, sharing profits and losses in the ratio of their capital balances. So we have that there again, right? So we have the information about capital, 100,000 for shut up, 150 for dance. Interest per annum is 10% on capitals. Drawings, 6,000 now, October 1st and February 28th. What's going on there? All right, well, maybe those are the days they took out the drawings. So maybe that might come in handy later. Interest is 12% per annum. Salary is 5,000 per month and 6,000 per per month. All right, net profit before appropriation was 173,140, but depreciation expense of 25,000 was omitted from the income statement. So you see, we have an adjustment to make before we start our appropriation section. Okay, prepared for the year ended 30th June 2017, a partnership appropriation. Oh, so we have a different year end and it's not December 31st. Okay, so what are we going to do? So even if you read a question and it seems a bit daunting, just take it one thing at a time. Start by heading up your question, your statement. You get marks for that. All right, so where am I going to go? I'm going to go here. Name, shut up and dance. What's the statement? Whoops, shut up and dance. Right, appropriation account for the year ended 30th June 2017. Okay, cool. Dollar signs, let's go. So it's net profit before depreciation, 173,140. What do we do with depreciation? Well, it's an expense that was omitted. And what do we do with expenses? We subtract them. So we're going to subtract depreciation, giving us 148, 140, I believe. All right. Now we could get to the interest on drawings. Now, let's take into consideration that the year end is the 30th of June. Now, and 2017. Now, the October 1st, it has to be that it was October 1st, 2016. So if the drawings were taken out on October 1st, that's October, November, December, January, February, March, April, May, June. If you can see, that's 9 months, right? So you're going to take a 12% of 6,000 for shut up and multiply by 9 out of 12 because the drawings was outstanding for 9 months. See, 12% of 6,000 by 9 out of 12, that's 540. What about dance? So dance took his or her drawings out on the 28th of February, so the whole of February was gone, right? Actually, I think February we had the 29th in 2016, but let's not get overly technical, right? Okay, so you can't count February. So March, April, May, June. So that's 4 months. So it'll be 12% of 8,000 by 4 to 12. 12% of 8,000 by 4 to 12, 320. 540 and 320 is 860. So we're going to get a 149,000 before appropriation. So now we could do our simple appropriation. Let's start with the appropriation, interest on capital. Okay, we have 10% of 100,000 for shut up, 10% of 150,000 for dance, giving us 25,000 as total interest on capital to the partners. Salaries, we have 5,000 per month for shut up, which is 5,000 by 12 is 60,000, yes. 8,000 per month for dance, 8,000 by 12 is what, 96? Ooh, wait, hold on. Sorry, oh, I was watching the drawings. Sorry, it's 6,000 per month for salary for dance. So 6,000 by 12 is 72. That's 132, I believe, giving us 157 of total appropriate. Oh, hold on. Wait. 157. But our profit to appropriate is 149. So what's going to happen here? There's going to be a loss to appropriate.
Now I did kind of foreshadow this if you were paying attention when I started reading the question. Look at the first sentence again. Shut Up and Dance are in partnership sharing profits and losses, right? Remember, the owners of the business, they get into business to make a profit, but there's always a risk they're going to make a loss. And who absorbs the loss? Who has to bear the loss? The owners. And in this case, who are the owners of a partnership? The partners. So what's going to happen here is we're going to have to share that loss in the profit sharing ratio. Now it's in the ratio of their capital account balances. What are their balances? 100,000 and 150. How do we find a ratio of that? Add them together and use that total as your common denominator. So Shut Up is going to be, his share is 100 out of 250. And if you cancel that, then you're going to get 2/5. 2/5 of 8,000, sorry, right, that's 3,200. And then Dance, right, that's 150 over 250, which gives us 3/5. That's going to be 4,800, and when you add those two together, you get 8,000, and that cancels back with the loss. Right, so I definitely wanted to show you guys an example with that. I've never seen a loss brought in CSEC, to be honest, but it is something that could happen, and I think you guys should be exposed to it and know how to deal with it in the event they do bring it. Okay, so I do hope that I've covered quite a bit of examples here, about 14 examples. Of course, as you could probably guess, they could pick and choose and mix up all these different technicalities and complications in any particular question. So all you can do is just practice as many questions as possible with different situations, different variables, interest per month, drawings per month on a monthly basis, the appropriation for part of a year, items that have to be subtracted from your net profit before you start appropriation. All right, but no panic, just practice as best you can and do your best. All right, okay, so I think that's it for this video. Let me just do my outro as per usual. So I'll see you guys across there. Right. All right, guys, so that is how you prepare a partnership appropriation account. If anybody has any questions, please feel free to leave them in the comments below, and I'll get back to you as soon as I can. All right, guys, so this is probably my last video for 2019, right? And what a year it's been. My first year on YouTube, right? Nearly 1,000 subscribers. I'm hoping to hit 1,000 before 2020. So if you haven't yet subscribed, I don't know what you're waiting on. Click that button. If you like this video, give it a thumbs up. And of course, when you do subscribe, be sure to click the little notification bell so you know whenever I release a new video. All right, guys. So for those of you who celebrated, Merry Christmas. For everybody else, Happy New Year in advance. I hope 2019 brings you great things. I know they say patient. Good things come to those who wait, but good things come to those who work for it. Right? Patience is a virtue, but you have to know how to exercise it. All right, guys. Anyhow, I don't want to get too preachy and go on too long, but I want to say thank you for everyone who's watched, who's shared, who's subscribed, who's liked the video, who's commented. Right? I've had people from all over the world. Right? People from Guyana, Barbados, Jamaica, Nigeria. Somebody from Nigeria messaged me this week going here. Somebody from Eritrea. All right. So I am so happy and flattered and humbled that you guys have taken the time to watch my videos. I enjoy making them. If you have any suggestions, please feel free to leave them in the comments below. All right. I'm open to criticism because I'm looking to improve. Right. I really want to bring you guys as much value as I can, because I really feel that accounts, POA, should not be it should not be presented to you in a difficult and boring way, right? I know I'm not the funniest guy in the world, and I'm hoping I could change that so I can make it a bit more entertaining, right? But of course, things take a little while to get flowing creatively sometimes, and sometimes things are just busy, and we feel a bit overwhelmed. And I just want to let you guys know, as much as you guys feel that with your studies and stuff, you are entitled to feel that way. We as adults feel that way sometimes with a lot of things. So just try and be kind to everybody you meet. You never know what battles they're fighting. Anyhow, guys, so like I said, you can be anything you want to be. You can do anything you want to do if you have the correct mindset and you put in the work. And you're bound to have difficulties. We all face difficulties, so don't feel that everybody else is doing better than you are, right? We all have struggles, right? And if what you're doing isn't working, then adapt, because change is the only constant. All right, guys, thanks so much for watching. I'll see you in 2020.